it used to be the case that commodities was kind of a niche investment. And in two respects. It was kind of a vehicle for speculative trading for the so-called CTAs and people that were playing the futures. So, and that was probably one of the main, the main activities, the main volume coming from trading like that. So there'd be speculation. There are obviously the people doing hedgers, but most of the interest was in kind of speculative short-term trading. That's on one side. And the other niche was some institutional investors had the desire for long-term protection from inflation. Okay, so that's kind of where we started from. And only within the last, probably 7 years, has there been kind of an explosion of interest in commodities. And basically it comes from, I think, more the institutional perspective that commodities can be, if you do it the right way, an effective hedge for inflation. So if these institutions that have very long horizon take this seriously, then why shouldn't I take this seriously in my portfolio management? Okay, so that's kind of where things began. And then 7 years ago, people start to argue that commodities not only could they provide a hedge for inflation, but they also offered extraordinary return opportunities. Indeed, some people were even saying that what you should expect from a commodity return, and when I say commodity, I mean commodity futures, was basically the same as the stock market. So that was kind of an extraordinary claim. And then the buzz really started. So what we've learned in the last 5 years is that, yes, commodities can be useful as an inflation hedge. However, you need to be careful because not all commodities are the same in terms of hedging for inflation. So to buy some generic index like the GSCI or the Dow Jones UBS, that's not what you want if you are just concerned with hedging inflation. You do better with the components. Some commodities are sensitive to inflation changes and some commodities are not. Indeed, some commodities might have the wrong sign. Okay, so people have realized that this could be useful as a so-called real asset. So people would be investing part of their portfolio in things like TIPS and things like real assets that it wouldn't necessarily be a commodity future, but like timber, things like that, that have kind of longer term properties that make them inflation hedges, and then the commodity complex. So I think what a small number of institutional investors were actually doing is now much more prominent in terms of large-scale portfolio management. That there is, without a doubt, a correlation advantage. So the correlation of commodity futures returns and, let's say, equity or fixed income is less than 1. So there's some diversification benefit. You need to be careful as to how to implement it, but there is definitely a benefit. I think that there was a lot of hype in terms of the returns. And I've got a research paper in the Financial Analyst Journal that really takes serious aim at some of the hype. So the hype using, back tests of commodity indices that, they weren't traded at that time, and many reasons to believe that you should not expect equity-like returns out of commodities. So my paper suggests with an active strategy on commodities that you'd probably expect 4%, and that's the premium that you would get. So remember, when you invest in commodities, you also have collateral. So you make some money on the collateral, If your collateral is like very short-term interest, then it's effectively zero right now, but it doesn't have to be. You know, it could be a long-term bond, it could be an equity. You just need to have collateral. But I mean, in terms of the excess return on a commodity portfolio, probably we're looking at 4%, which is not bad if you do, as I said, active management.